Hello, everyone, and a very warm welcome to today's major markets update for Wednesday, December the 4th, 2024. I don't have a fancy introductory slide because I have been uncreative. Today, I can't come up with something. Everything is on track. We're still in a bullish mode. We see nothing bearish at all, other than risk is of course rising as prices move higher, but we have zero sell signals. Yes, we have reached some of the target zones for some of our indexes, but that's about it. Markets can always extend. They don't have to top at a certain Fibonacci extension. We will know the top is in based on our warning levels. That is the beauty of the Elliott wave. If I forecast we're going to go to 6,060 to 6175, and we're going to 7,500. Yes, I was wrong, but that doesn't mean you should have already sold. You can use those warning levels. We cannot predict the future, but we do know that as long as we stay above our warning levels, we can move higher. Once we start moving below those, we have to start paying attention. So yes, risk is rising, but we have still zero indications that a top is in place. So 6,060, 6175-ish, somewhere around there remains our target zone. We've now blasted through S&P 60, so I think we can reach the upper end. But just because I think that doesn't mean we'll get there. Again, we are 70% reliable, 95% accurate. So that's all we can work with, and that's why we are sometimes wrong and hopefully most of the time right. So we start here with the Dow Jones and the advance that we've been in since the summer of this year. We're still tracking the completion of this gray C/3 wave. We don't know if it's going to be a 5-wave advance or not. Once again, I cannot predict the future. So we start off with A1, B2, C3, and then we'll eventually see if we're going to get a 4 and a 5 out of it. We're still here at this upper trend line that has held all upside in check. I wouldn't be surprised if we see an overthrow and then a fallback through it for this red wave 4. But that's maybe wishful thinking. And again, we can easily reach the 45,200 to almost 45,500 level. We haven't really reached it yet. And over the last couple of days, I said we're still wrapping up this smaller 4th wave. And this little candle here could have been wave 5, could have also been part of this 4th wave. The 2nd wave was just intraday, and the 4th wave was then 1, 2, 3, 4, 5 days. It's fine. We have not broken below any warning levels whatsoever. So we can raise those. Okay, we're going to raise the first warning level is then today's low. And the second warning level will be, I would say, yesterday's low. I'm going to lower it a little bit. We're going to give it a little bit more leeway. We're going to put it here at about 44,400, which is, of course, the open, as you can see here, and the intraday low here. So that matches quite well. And again, we've not really reached the target zone just yet. So it would be nice to see a little bit more of a squeeze coming out of this. Negative divergences are still building, but again, divergences are only divergences. They're not trade triggers. Prices. So ultimately, we need to break, of course, below the mid-November low here, which is at about 42,300 or 929 to be exact. And if we break below that one, we definitely have confirmed this wave 4. And if we break then even below 41,630, somewhere around there, this wave 4 becomes a question mark. And of course, in the end, we need to break below the April and, the August to April level. So we have a lot of leeway for the bulls. But again, once we start breaking below 43,500, when we do that, that should be early warning enough to get out. And I believe more and more, that's simply my job to warn you of a catastrophe looming. For the rest, just stay in the market, okay? That is, I think, the most important part of what I do to make sure that you will not get caught on the wrong side of things, that you lose as little money as possible when things go sour. And with losing money, it can also mean that, we top out at 45,000 and you will eventually exit at 40,000, something like that. And you've been long for 10,000 points on the Dow, right? You can never, ever exactly get out of the top. that is really as good as it gets, because most people will probably only get out when we're at 20,000. You know what I mean? So that's where you save most of your money. So then we go to the NASDAQ 100. Again, on track. We've always been looking, I would say, for that 21,500 level. I haven't even reached it just yet. Got very close, 21,498. And there's a lot of boxes here to show you all the different wave degree target zones. The red box is the normal wave 3 target zone in a diagonal. We still count this as a diagonal. It still looks more like ABCs to me than 1, 2, 3, 4, 5s. So the normal target zone is 21,500 to 21,868, somewhere around there. With the lower end, the most typical one. But just because it's the most typical one, again, does not mean the market has to do it, right? It doesn't owe us anything. Again, I have zero indication that the low is in place. Everything is pointing up and is strong. So we can easily go to 21,868. So we've raised the warning levels. That's pretty much all we can do. Stay long and strong. The first warning level is today's low. And then the second warning level is the previous all-time high at about 21,150. And then the third one remains in place and the fourth one remains in place. So ultimately, we need to drop it below the November low, the November 15 low, I believe it is, to really suggest that this red wave 4 is in place. Again, I'm still missing a larger 4-5 sequence since the August low. That is an absolute, in my humble opinion, 99.99% guarantee that we're still missing this 4-5 and that we're still in this subdividing wave 3. Now, the green target zone is, of course, the ABC pattern. So we're still in this, oopsies, that one should of course not be there. That is not a C wave high. Could have been, but market decided not to. So that would be the green wave C for the length of A, and then of course measured from wave B. And again, the target zone is anywhere between 0.764 to 100%, can always extend, to be determined. But these are normal C wave extensions. Then the gray one is, of course, the length of this wave A, measured from this wave B. And it has a much bigger target zone, as you can see. And again, we're starting to get into this overlapping region, right? Most of the time, the market will seek out those overlaps. And then the orange one is another wave degree lower. So the red is intermediate, the green is minor, so the wave degree lower. The gray is minute, another wave degree lower. The C is the, I believe, micro level, so another wave degree lower. So that's what we're targeting for. You can see all this confluence is in this red target zone. I would be surprised if we go to 22,460. It's not impossible. I'd be very surprised. So again, we're reaching now this target zone that we've been gunning for quite a while. And so far, so good. So we've raised the warning levels to tell us, okay, we're starting to top. I know the jobs report is out on Friday, but as you know, we really barely ever mention those type of events because price will tell us what happens. How the market reacts to it, to be determined. I don't know the numbers, and I couldn't care less. Honestly, I forget about those things. So then bigger picture-wise, here's a very bullish setup, the way we can count it. Again, Elliott wave is an interpretation of the price action where we are in this third wave, anywhere between, I would say, 23,000 to 26,500. And then we get a 4 and a 5. This is still very possible since the 2020 low, a massive, super extended primary wave 5. I know I have the red or the pink 3 and pink 4 here as well. It is possible. And then we're simply in this pink 5. It's a bit potato. Honestly, all roads lead to Rome, so to say. We still have this 30,000 upside target. It's still possible, okay? I just want to point it out that we're still in a very bullish run. We have no bearish indication whatsoever. We're going to go with this one. But for now, I have zero indication that the top is in place. Not at all, nothing. If anything, we'll just have a local top. We'll probably get about a 5 to 10% correction at the most. With 10 being at the most, 5 probably minimal before we start moving higher again, with a minimum upside target of 22,460, potentially to the 200% extension, which should target, I believe, somewhere around, yeah, that would be 24,500, somewhere around there. But we're not there yet. We still need to go through all the machinations of the smaller C waves, the 4 and the 5. So again, I see no long-term top in place since the August low. Semiconductors, this is the adjusted expanding ending diagonal option. where we can still target this 5200 plus or minus 50 level for this potential wave 4 and 5. Again, this price action ever since the October high is nauseatingly overlapping. So this is the best interpretation I can give you. Take this please with a grain of salt, because the semiconductors has of course been the most difficult one to track and count from an Elliott wave perspective. We're just above the 50-day simple moving average. That's about it. And it's all been ABCs. It's been ABCs up and ABCs down. So it's still tricky. But I think once we put this potential wave 3C target here, we are still good on this upside. I think we've been looking for more upside over the last 2, 3, 4 days. So that's pretty good. We'll stick with it until it changes. Once again, if we break above, I would say 5250, odds really increase that this expanding leading diagonal is not correct. I think it's a very loose interpretation at this stage. So at the moment, don't count on it. If it happens, I'll call myself a Nobel Prize in either wave, because that's really thinking 5 turns ahead, so to say. But if it doesn't happen, I wouldn't be surprised. So we have the warning levels in place for the bears, and the simple warning levels for the bulls are that we need to hold the December low. S&P 500, again, the 60-60 level was the minimum upside target, adjusted it slightly, 60-70, but we've already surpassed it. And also here, similar to the NASDAQ 100, we have all these target zones. This is the typical wave 3 target zone in a diagonal. We can easily go to 62.75 if the market so wants to. It doesn't have to do 123.6. We can get a super extended C wave. And then we have the green target zone for the green C wave, akin to NASDAQ 100, again, anywhere between 60.70 and almost 6,200. And then the gray target zone is anywhere between, I would say, 1605 to also almost 6200. So with this break above 6070, we can easily target 6148. Okay. And if we then drop from there, most likely we'll seek out the 5810-ish level, the 76.4% retrace. And then we should shoot up all the way to 6350. But we can easily go to 200%. That we don't know yet. For now, we're still in this C wave. We've reached the minimum upside target, and with today's price action, it looks like we're going to extend a little bit higher. Continued, of course, on holding above the warning levels, which we can confidently raise. So the first warning level is now, of course, today's low. And as you can see, that is very close to where we were on the previous high earlier this week. Then we're going to raise the second warning level as well. I'm going to put it at the previous all-time high there, which is somewhere around 60.18. And I will keep the third warning level. Should we raise it a little bit? Somewhere around here, somewhere in this region, somewhere in the 59.50 region, and then of course the final warning level. So, you know, the bulls are in charge, comfortably raising the warning levels. I see nothing bearish yet. Again, we're well above the rising 10, 20, 50, 200 day, above the Ichimoku cloud. Everything is pointing up. So this is still a 100% bullish looking chart. Yes, all tops occur when the market is in a bullish posture. And of course, all bottoms occur when the market is in a bearish posture, meaning where is price in relationship to the moving averages and where are the moving averages. But for now, this is where we have to go by. So a break below today's low is about 60.50, I believe it is. Or 60.60 is a first indication, right? That is simply our radar lock. The second is, of course, our proverbial shot across the bow, which is the gray level. Okay, that's when we start paying attention. Like, uh-oh, the bears are, ramping up. If we get the third level, it's a direct hit. That is, as I said, at around 59.60. And if we break, of course, below the November 15 low, then this wave 4 is fully confirmed. And as you can see, we're already getting pretty close to the ideal bottoming zone by then. But that is simply the nature of Elliott wave and the price levels we have to go by. But of course, I would already be very cautious from a swing trading perspective if we start breaking below 59.60. And ultimately, there's no bear market until we break at least below the August low. Okay, that is the ultimate price action. But by then, I'm pretty sure we've had a lot of other indications based on market breadth, negative divergences, and all that good stuff. So you'll be the first to know. IWM, similar to Dow Jones, could have topped here, right here at the 245 region. And could still, again, squeeze out another fifth wave a little bit higher. Doesn't have to. We are below the first warning level. That's about it. Okay, the second warning level is still for the IWM at about 235-ish. All right, so those are the indexes. Let's look at market breadth. The bullish percent index for the S&P 500 is gaining with price. Of course, not as high as it was in the fall of this year. So we still have that potential negative divergence, but we're rising and above 70, so that's strong. The AD line has slight negative divergence. That's about it. We had negative divergence here between October and November. We got the smallest of corrections here into the November 15 low, and it's since been erased. We've made a new all-time high late in November. Okay, so that's of course still bullish, and hence why we're still rising in price, because price is just following along with that high. But now we start to see potential negative divergence. It's just a condition, not a trade trigger. It doesn't mean you have to throw all your positions out the window and do a Chicken Little. It's just an observation. This negative divergence will have to persist for many, many months before it really becomes bearish. New lows, well, benign, 37 for the NYZ, 73 for the NASDAQ. So nothing really major about that one. How about our longer term model? Still 100% bullish. It has been bullish for a long time. Pretty much almost all year. So also this one is not giving us any warm, bearish, fuzzy feelings. It gives us a warm, bullish feeling. Okay, so this is what the data tells us, or this is what we stick with. How we're doing with our buy-sell indicator remains on a buy. We had a weak sell signal earlier. It's completely eradicated, so to say, and we're racing towards the ideal top zone, from where we then get a better sell signal. But for now, no sell signals. So as you can see, price is not giving us a sell signal. Technical indicators are not giving us a sell signal. Market breadth indicators are not giving us a sell signal either. Let's quickly look at the McClellan oscillator. Hopefully it has updated for the S&P 500, the SPX MO. Interestingly, it is dropping to -9 while market is rallying. Okay, so that's not a good sign. That is not a good sign, but it's not the end of the world. It can always be eradicated. So the SI is starting to turn over a bit. So that is interesting that apparently more stocks were declining in the S&P 500 than rallying. And again, that starts to favor, in my humble opinion, the big tech stocks. I know the Magnificent Seven have been rallying really nice. And we've had some really wonderful trades in our Secret Service, which is now, of course, the Mag 7 Plus service, where we give daily trade alerts for these tickers like Apple, Amazon, Meta, you name it. And it's been really a fantastic trade. Apple, we've been short-term long since mid-November, long, I think, since June. Amazon, we just had a buy signal last week. Wonderful, starting to sell. Google is still looking good. Meta, Microsoft, everything is moving along. Even in buy signal for NVIDIA, hopefully it's going to work out. Tesla, of course, doing great. So that's been fantastic. There's many ways to make money besides the market. You can use this Magnificent 7 ETF trade alerts. It really complements, of course, what we do here as well. This is just our interpretation. Those trade alerts are pure price-based, fully objective. There's no analysis that go in it other than our trading systems that have been thoroughly vetted and back-tested. So they work really well. Again, we've been long Apple since 2 weeks now, and it's been a fantastic trade. Not all trades work, but that's fine. That's life. So that's what I have for today. Please give those other services a chance if you so desire to make more money. And again, it can complement your trading really well if you base it on my analysis, which is, of course, in the end, always objective. I'm human and prone to mistakes. I apologize for those in advance, but I cannot be perfect because there's no market guru. And then you can use those trading systems if you want to have exposure to some other ways of trading, which I can highly recommend. All right, so that's all we have for today. You can still go a little bit higher for the Dow Jones. We haven't reached the ideal target zone just yet. Same here for the NASDAQ 100. There is still upside potential. A break below today's low would be a first sign of a top being in place for all these indexes. Semiconductors still remains the ugly duck. So for now, we also then provide a ugly duck resolution to the price action that we've seen since the October high. While all other indexes essentially are at new all-time highs, the semiconductors are still struggling, and back to where they were in May of this year. Don't like it, but we'll see how it's going to progress, if we're going to get that steep wave down or not. The video looks pretty good to me, so it might not happen. To be determined. And again, don't front run this, right? Don't think, oh, I'm going to short it here. Don't wait for confirmation. Always wait for confirmation. That's what you need to do. Don't front run things. Wait for a buy signal. Wait for 3 waves down. See then if you're going to get 5 waves back up, or when the CSA is reached, that type of stuff. Don't think, oh, we've just stopped, and please don't do that. Make sure you follow the market, because the market won't follow you. S&P 500 most likely going to move higher. 6150-ish seems to be a very good next upside target. And from there, we can then assess if the market decides to even subdivide further, tag on another ABC. I can't predict the future. I only look at these price levels, and we've reached the 60-60 level. We've breached above it, so it seems most logical to assume that we're going to go a little bit higher. 6150, I would say, plus or minus 25 seems to be the next logical target. All right, enough said. Take care, trade safe, and have a wonderful afternoon, and I'll catch you all on Friday.